Welcome. I'm Rachel Ivanovich here with Vince Stefano and Greg Carroll. We are here to provide you with some insights on the market, investing, taxes, and planning. So we've had a really busy week. Vince, what's been on your mind?
A lot.
I figured.
I just want to say to clients that are over 70 years old, 55 years ago, 500,000 people descended on a small town in upstate New York for 3 days of peace and music. And you know that town, Woodstock. There you go. So bring out your tie-dye shirts, kick back, reminisce about the 60s. And while I say that, I'm going to reminisce about second quarter earnings because I've been talking about those the last couple of podcasts we've had. Pretty much it's done. There are only one or two major companies that are going to still report, but profits look pretty strong. S&P companies reported a jump of about 11% in second quarter earnings year over year. The problem was revenue underperformed. Profits were made by one-time items, cost-cutting, especially restructuring with job losses. One of the things that was said, and I want to share this because we saw some retail sales numbers that were very good today, up 1%. But a lot of companies in their second quarter earnings call talked about how the consumer was cutting back on little things. McDonald's, Starbucks, Chipotle, I am not recommending buy or selling these companies at all. I'm just going to comment what they said on their conference call, that customers were looking for cheaper items. In addition to that, they were saying that lower income customers were dropping out of the market completely. Two other companies, again, I'm not going to recommend buy, sell, or anything. Lam Research and Pepsi. They were saying that shoppers are buying less French fries and potato chips. God help us, how can you have hamburgers without French fries? I don't know.
It's a meal. It's a package.
Yeah, there you go.
I just eat the French fries.
No, the third point I want to make, and it's high-end shoppers are also economizing. Some of these very high-end goods stores like Louis Vuitton, Dior, their sales were tepid, up 1%. Gucci was actually down 1% or 11%. And again, I'm not recommending these companies at all. They're not part of the S&P 500, but it kind of shows you where what's happening with the ultra-wealthy consumer. High interest rates have been weighing on banks, and with big technology companies, there is absolutely no let-up in artificial intelligence. They are spending billions on their dreams to make AI a reality. The only question is investors got a little cautious in the second quarter because they just were not sure whether all that spending was going to translate into earnings growth going forward. So what's it all mean? Well, the market has been looking at it and saying, okay, are we going to have an economic slowdown? Is there a possibility of a recession? Is the Fed going to cut interest rates? Now it looks like they will. There's still political uncertainty. There's uncertainty in the Middle East, and we're in the dog days of summer. And so all that translates into very near-term market volatility. So again, if you are in the market, stay with very high-quality, dominant, rapidly growing companies, and don't play politics with your portfolio.
And I think, to go along with that, there is still a big concentration in where a lot of investors are investing in these mega cap technology stocks. What do you see the earnings doing the second half of the year with those? Are they still going to be growing at these hypersonic rates, or it seems like people are not as diversified as they maybe should be.
What you're seeing with some of these big mega cap tech companies is now all of a sudden they're struggling with the tyranny of large numbers. It's one thing when you see some of these companies growing at 40-50%, and now all of a sudden they're multi-billion-dollar revenue companies, and they may grow at 20%, which is still a fantastic number. But unfortunately, the street sees that differently, and the momentum traders and the algorithmic traders all of a sudden start taking the stocks down like, there's no tomorrow.
Right. And so it's been interesting the last couple of weeks because it seemed like, money was kind of flowing out of those big cap tech stocks and kind of going into small caps and defensive companies. And then we had the unwind of the so-called yen carry trade a week ago. And then boom, a week later, everything's rushing back to where it was right before that. So
I mean,
I think the
Dow's over 40,000 again.
You know,
I mean, it's just like
diversify.
Yeah, it's like nothing
Stay
ever
diversified.
happened. Like nothing ever happened.
So
You know?
take some Pepto-Bismol and hang on for the ride.
Pepto-Bismol, that's what people take when they come see me for taxes.
Take a big swig right before the discussion.
Yeah, I've been talking to a lot of clients about Roth IRAs recently. Many people are inheriting IRAs, and one of the benefits of a Roth IRA over a traditional IRA is there is no required minimum distribution if you open a Roth until you die. And whoever inherits that Roth, the rules are really complicated. And so I've had a lot of people calling me saying, help, I just inherited my parents' Roth IRA or my siblings' Roth IRA. What do I do? When do I have to take the money out? How is it taxed? Is it taxed? And the rules are really complicated. So my advice is call your tax advisor. Or call us. I'm happy to explain the rules, and I won't go into it and bore everybody about it, but the rules are very complicated.
We've had several clients who have inherited IRAs since 2020 when they changed the rules from if you're a non-spouse beneficiary, you used to be able to stretch that IRA for a long time. Then they said in 2020, 2.0,
there was the Secure Act.
Secure Act
that changed
2.0.
everything, and then there was the Secure 2.0 Act.
Yeah.
So that changed things even more. So it really depends on what kind of a beneficiary you are. So, for instance, if you do inherit that Roth or a traditional IRA from your spouse, the rules that apply to you are completely different than if you are a sibling of someone who
Right.
left you their IRA. So again, like I said, there's no one size fits all for this, and therefore you need to do a little digging, a little research, because with Roths, because they are different than traditional IRAs, the money is tax deferred. You don't pay tax on it. When you put the money in, it grows tax deferred, comes out, you pay tax on all of it. Whereas with the Roth, you pay tax on the money before you put it into the Roth account, and then later, the goal is that the money comes out tax free, but that's not always the case. Things can backfire.
Yeah, there's a lot of moving parts with the Secure 2.0 because they just clarified the 10-year rule that you have to take required minimum distributions as a beneficiary next year. But yet you might have inherited this in 2020, and they're like, are we supposed to take RMDs? Are we not? And
do we have to take RMDs 2020 through
Do we have to do a catch-up?
Yeah.
Yeah, so it's been...
it's been fun. The rules are confusing.
Yeah.
Talk to your advisors.
This is definitely a professional conversation you need to have.
Well, I got to go around the table because I'm going to ask everybody right now, because there's a whole talk about the Fed cutting interest rates. And recently, banks have been struggling a bit because, they have to pay higher yields to keep depositors depositors happy. Also, refinancing of mortgages has been down dramatically, so that's cut into their margins. So my question is, I'm going to go around the table. Rachel, what do you think?
Do I think they're going to cut rates?
Do you think they're going to cut rates?
I do.
Okay. Greg?
Well, at least once before the end of the year.
25 bips in September.
Agree.
I think and I wouldn't say it's 100%. I wouldn't, bet the farm on it, but I do think it's highly likely
before
in
the end of the year.
September. Mm-hmm. Well, definitely I would say 100% by the end of the year. September is going to be interesting. I mean, if the consumer, is still continuing to spend, and the initial jobless claims are coming down a little bit. I don't know. It's not an easy thing for the Fed to time this, especially with the lag effects of hiking rates and then lowering rates. It just doesn't happen right away. The effects don't happen. So I think they're probably near where they need to do it. Yeah,
I agree, and I think the market could, either continue to, accelerate, or it's going to, buy on rumors, sell on news. So I don't know, but I do think the Fed will cut. I do think they will cut 25
in September.
Yeah. Everything's kind of looking towards that, but again, the Fed could change their mind.
Data dependent.
Yeah, very data dependent. Yeah. But, hey, we're middle of third quarter right now, and, the market's rebounded quite nicely. We've been telling everybody, in some of our last podcasts, not to get nervous, to, stay with your asset allocation, stay with your plan, and look what's happened. Market has come storming back the last 3 or 4 trading days, and, again, it's been led by the mega cap tech stocks, which everybody goes back to because that's where the growth is. That's where the revenue and earnings consistency is going to show.
And the interest rates don't really matter to them as much because they've got plenty of capital to keep growing and investing in their business. So, yeah.
No, that's true. And again, find good companies with, rapidly growing, and they'll throw off tremendous amounts of free cash flow, and that's what you want your companies to do.
Yep. Well, I think that's probably it for this week. Thank you for joining us, and check in next week for another round of WWM Talks.
There you go. Bye.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.